Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man all the way from the city of brotherly love, Dimitri Pargamonic. Dima, you there? There he comes. How are you doing, my friend?
Pretty good. How are you? Well,
good. You see the disclaimer up there?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I in Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. If anyone out there is joining us for the first time, just a quick description of what we do. We do this show every day to answer any questions you have about Market Chameleon tools, data analytics. If you want to bring up strategies or something unusual you've seen, you're welcome to ask those questions. Or you could come on a show live and ask the question. So the two ways to do it is put the question on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show live, we also provide a link to Zoom. If you click on that link, it takes you over to Zoom. Once you're in Zoom, click on the button, raise your hand. You don't have to turn on your video camera. Once you're in, everybody could hear you and you can ask your question then live and direct. While we're waiting for questions to come in, we'll start out with the pre-market report, give a little time for questions for people to put in their questions. If we don't get any questions, I'm going to default to a couple questions that I got over the email. It really has to do with implied volatility rankings, and I think some of the ways people are using them. So let's have a discussion about that. So I'm going to start out right now. Pre-market will let me know if questions do come in.
Perfect.
All right. So pre-market report. These are stocks trading at pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Down here, I see 60 stocks made our percentage gainers list, 36 on the decliners. From this perspective, we're looking like we're setting up for more bullish bias at the open. As you can see, though, here we have stocks that are small cap stocks, ETFs, closed-end funds, leverage products, preferreds, anything that's listed on the major U.S. exchanges that can be traded in a pre-market hours and meets our thresholds can make this list. And we want to narrow down the list to a group of stocks, maybe to get better insights. And what I'm going to do is narrow it down to S&P 500 companies. To do that, I'm going to use this filter in ETF, drop it down. You get a list of ETFs to choose from. The first one, SPY, is the S&P 500 ETF. So clicked on the wrong one. Let's go SPY. When you select it, the list below gets filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here, 8 stocks made our percentage gainers list. They met our thresholds, none on the decliners. So slightly positive bias at the open. I do believe we get some Fed speakers today. Powell will be speaking today. So we'll look what kind of indication he says, or if he gives us any kind of forward-looking guidance. So that will be interesting. I think there might be another speaker today as well at 2:00. So something to keep an eye out for. I think that's coming up today. Let's see, it's 9:05. So if there are no questions, I might go to the implied volatility rankings and start discussing those.
Perfect.
All right. Let me go under here, IV rankings. And this is a list of stocks. As you can see here, we have an implied volatility for the stock. And of course, implied volatility to derived value. So we look at the implied volatility on the 30-day constant maturity at the money. kind of what the VIX is calculated. And then when we look at that implied volatility to get a ranking, we have to compare it to something. And usually the IV ranking, you could compare it to historical implied volatility levels and then give it a ranking. How high is it relative to where it usually traded in history? So their Bed Bath and Beyond 353 implied volatility, and we have two ways of ranking it over here against historical IV, and we could also compare it to realized volatility in the most recent history. So what is the IV percentile rank? That's saying that 99% means that if we took 252 days of it, in this situation, we're looking back 252 days a year. And what we're saying is how many of those days were below 353. And here it's saying 99%. Okay. Then another way people like to look at it is, okay, if I just took two numbers, the high and low for the year, where is its position relative to the high versus the low? So 90% percentile means that if we just looked at those two numbers, it's and looked at the percentage of the way from the low to the high, it's 90% of the way there, okay, from the low to the high. And so sometimes, first of all, I get people, and we discuss this a lot, why is your IV different than like somebody else's IV, or on the trading platform or whatever. And IV, it's a derived value from a model. It's not something where it's not a price of a stock that traded and you said, okay, here's the last trade. This is the price that it traded at. Applied volatility, it's taking inputs from observed values in the market and putting it into a model to come up with a implied volatility. Okay. We did a lot of videos on this already if you're interested, but you wouldn't be able to match up one person's implied volatility with the other because they could be using different methodologies to calculate it based on how they're treating days to expiration, interest rates, which options they're looking at, what how their weighted average between strikes. All these factor into how you calculate implied volatility. We do it based on our methodology, that we've been tracking for many years. But what I wanted to then kind of discuss is that when people use implied volatility, they look at this implied volatility is high, or the implied volatility could be low relative to history. Well, that doesn't necessarily mean because it's high, you should be selling it, or if it's low, you should be buying it. Okay, that's not what this is saying, and I'm not sure why people, where they're watching videos and who's telling them to do that. But when we're looking at it, IV rank, it just quickly tells us what's going on. It gives us information about that, okay, something might be going on, or why is it, and you want to look further. And when we look at implied volatility, that's coming from options, you need another expectation to compare it to. And the expectation will be, well, what do I think the realized volatility will be? What do I think this is the forecast of the market for volatility in BBY, all right? But to really try to see if the market's expectations are high or low, you would need to model out what you think the expectations for the actual volatility will be going forward. All right. Because if you don't have that, then you're not really making good decisions, because then all you're doing is just following a number. And I think a lot of people want to just look at a number, make it very easy. If this is high, I'm going to do this. If this is low, I'm going to do that. But all it's doing is giving you some information. But in reality, if you're trading implied volatility, that means if that's what you're trading, that means you have to have a model to trade the realized volatility to spread the two off, right? So you think implied volatility is high, well, you need to trade the realized volatility. And if the realized volatility is less than the implied volatility, then you'll make the difference between the options and the stock, right? But that's what the model is indicating. So just looking at this number and going out and just selling an option or buying an option, well, you're not really then trading implied volatility. That's what you're doing. Okay, so to trade implied volatility, you'd have to have a way to forecast a realized volatility that creates an expectation for you. And then you'll have to be able to trade the realized volatility against the implied volatility. And that's what the Black-Scholes model is. Okay, that's what the binomial is and so forth. So that's why I get these questions, and it's very odd to me, and you must be seeing videos out there and somebody's probably saying, high IV sell an option, low IV buy an option. But you're not even trading implied volatility, really. If all you're doing is buying or selling an option, you got lots of risks with that option. And if you're not hedging your deltas or gamma, you're not even trading the volatility. And I'll give you some examples of that now. So like BBY, well, what does that mean? 353 sounds high, but the question is, well, what is your expectation of volatility? And do you think that the options are underpriced or overpriced? So I'll just give you an example here. Let's go in BBY. So this is Bed Bath & Beyond. And first, why is it high? And you have to go and read the story of what's making it high. What are people doing? What are people betting on? What are the different factors that can make it move around? So here I just see it from yesterday. It was up. The stock itself was up 92%. Today in the pre-market's down 40%. So you could see it's volatile, right? So something is going on in the underlying, and people miss this part. Well, what's going on in the underlying? Because if you're doing an option, which is a derivative, you should really know what's going on in the underlying, which will be more important than just looking at the implied volatility, because that's how you really need to make your assessment. Do I understand the underlying and what's going on? And can I make a forecast myself into the volatility where it could possibly trade? So let's just take a look at, for example, easy one like a straddle. So Feb 10, here's Feb 10 expiration. And we see that the premium in the option is 39.8% in the straddle, which translates to $2.36 with 4 days to go. Well, do you think this is high? Like, does this seem, high to you or not? And you'd have to form an expectation. Where do I think that the stock can end up in the next 4 days? So if you think the stock is going to trade in a 50-cent range or dollar range, then that could be high. If you think it could trade in a $3-4 range, that it could be low, irrelevant of what this says. Okay, so we know. So look at just yesterday, BBY traded from $3.11 to $7.03, right? Almost $4 range yesterday, and ended up 586. This morning, it's already down 240 in the pre-market, down 41%. So this implied volatility could still be low based on where the realized volatility in the stock is heading. And it's important to understand well, what's going on in beauty? And I think that they're going through some bankruptcy, trying to raise money, something like that. I don't trade. I just kind of picked it. It was the first one on the list, and I know it's been on the news. It's going through some, some issues, solvency issues. So maybe the expectation is in the next 4 days, if it doesn't get anything done, it could be, 50 cents, go $1, who knows? Or if it does get something done and raises money, maybe then it's $10. So if that's the case, then these are not that expensive, even though the implied volatility is high, right? But the other part of implied volatility is it's the expectation of the fluctuation in the stock. Okay, so when you do and I'll show you here. Let me go to SPY. It's my favorite one to go to do demonstrations. I'll just pick out a month here. Let's go to a little bit further out. What's the next? Feb 17th. So some people might look at the implied volatility and think that that's a good time if implied volatility is low. So if implied volatility is low, I want to do a debit spread. That's what they say. Well, first of all, debit spread, if all you're doing is buying a debit spread, like a put spread or call spread, it's got other risks involved, and you might not even benefit from an implied volatility move to the upside. Okay, you might be, depending on how you structure it, you might be, short the implied volatility. So let's take a look at example here of somebody who is saying, okay, implied volatility is low, so I'm going to go in and buy this debit call spread. What's a debit call spread? Here, I'm buying one call, all right, 410, and I'm going to sell the 415 call. Okay, so here you could see that I'm net buying basically, right? Premium in this situation. Basically, I'm going to buy some for $6, sell something for $3.55, right? And if I do that, right, here's my risk. I need the stock to go up, right? At expiration, I need the stock to go up. So what is volatility? Well, volatility, remember, it's the price fluctuation of the stock, right? It's not a direction, it's price fluctuation. So imagine this, that right now, SPY tanks, right? Tanks 10%. Well, that would be really volatile. And then it goes up, back up to the same spot. Then tanks again 10%. Then goes back up. Tanks again, goes back up. And it keeps doing that every day from today to expiration, right? Goes down, let's say goes down to 380, then comes back up to 410. Goes back down to 380, 410, 380, 410, and then ends up at 410. So that kind of volatility, if you're trading volatility, that's a dream for somebody long vol, right? If you're buying it low and that's happening, well, if you're trading volatility, then you should be making a fortune. But if at the end of expiration, the stock is right there at 410, you lost all that debit. Basically, if you just bought that debit spread, and even though the volatility was high, you didn't benefit from it, right? There's no way you benefited from it because you're actually not trading volatility. What you did was you bought a call spread, and the call spread, right, has delta risk, gamma risk, some vega, theta, and so forth. So in actuality, this will just, at expiration, you'd have lost everything, even though the volatility, the IV could be through the roof, and this could go, from 17 to 30. Okay, so you wouldn't benefit from a debit spread. So let's go the other way around, right? I'm going to show you credit spread. Let's say the volatility is really high. I'm going to sell it put spread for credit. So where's the stock? I forgot, 410, right? So here's 410. Let's say I sell the 420 put, buy the 411 put. So you could see here, I'm going to be selling something for $11, and I'm going to be buying something for $5.73, right? So I am getting a credit, right? And let's say that the volatility between now and expiration is 0. Best case scenario, it's exactly 0. That means the stock never moves from now to expiration. Okay. But what you're doing is, to demonstrate, is you're actually not selling, you're not trading implied volatility. That's what I'm trying to show you guys. So if you're trading implied volatility and you think because I sold a credit put spread, I'm short IV, this is the best case scenario, 0, right? The stock moves absolutely nothing, 0. Whatever the price is today, that's the price every single day till expiration, and then these options will expire. So now you think, well, wow, well then I should have killed it, right? I'm trading IV, implied volatility went to 0, realized volatility went to 0. But let me show you what happens. Here's your payout, negative 354. So the stock is at 410 and you're negative 354. Why is it the case? Well, you sold the 420, 411 put spread, right, for $5.46. But the stock expired below 410, which means that both of these puts are in the money. Both puts are still in the money. So that means you have to buy the spread back for $9. Stock moved at 0, you have to buy back for $9. You sold it for, $5.46. So there you go. So what I'm saying is you're not actually, when people are looking at IV and then doing strategies, you got to be careful what you're doing, because you're number one, what is your expectation for realized volatility? You need that, or you can't just use the IV rank. You still need the part, what do I think realized volatility will be and why? And the other thing is that the strategy that you're using, you have to know that how to trade the realized volatility versus the implied. Because if all you're doing is trying to screen for a credit spread or a debit spread using an IV rank, then you're not really even trading implied volatility. Like the implied volatility would be almost irrelevant to the way that you're doing. So just wanted to bring it up because I think that keeps coming up, and it must be something out there, some videos that people are watching telling them to do that. And just want to show you guys it's an appropriate look, showing you right here. Here's a credit spread. Best case scenario, 0. All these vols go to 0. Stock never moves. There's no volatility. And you could see here that that's not what you're doing here, right? What you're actually doing is you're putting on a spread that has a bullish bias. Okay. That's without hedging anything, that's what you're doing. So just wanted to kind of show you guys this. Hopefully this brings things to light. And even though, I do talk about it, I feel like I still get the same questions popping up. So let me know if you have any questions on that.
Is Chris Emery just popped in? Is that true for IV for calendars as well? I mean, we only got 4 minutes left. I don't know if we want to carry that through tomorrow. It seems like it could maybe be a longer question.
So, right. So so there's a way to use implied volatility to price options versus each other. Yes. And in a calendar spread, you are, depending on what the calendar spread, how you structure it, you're going to be long Vega or short Vega. So that is true that you do have an implied, that you do have a Vega bias. You want volatility to either go up or down, depending on which side you're doing. But you also have some gamma risk in there. So you do have movement to the stock. Okay. And, there are factors involved there that need to be discussed even in the calendar spread, because it depends on binary events and earnings and stuff like that. But I would say calendar spread, you are kind of hedging off, implied volatilities for a time period. It's a good question, but there's other variables and factors involved that you do need to understand, right? So I don't want to say exactly yes that you're just trading implied volatility coming in or going up. There are factors that you need to understand, when you're trading options for implied volatility. If you read the Black-Scholes model, that's the model of trading implied volatility, it'll show you, that you're hedging these risks that you have on your delta, gamma risks, and so forth. So you could scalp realized volatility against implied volatility, right? So it is a trading model. It's a trading model supposed to be used and traded in a certain way. It's assuming you're doing it, but you can't just take an IV and say, I'm going to go put on a spread and I'm trading IV, because that's not what you're doing, right? You're looking at two numbers and maybe that's how you're basing your decision, but you're actually not trading implied volatility. And as you could see here, this is an example right there. You got to be careful, how you're doing it. Maybe I'll follow up a little bit more and talk about it. But why do you need to forecast a realized volatility when you do implied vol? So think of it options are derivative, right? And let me just paint a really quick analogy, right? Let's say you're looking at mortgages, right? So mortgages are tied to real estate, right? And let's say you wanted to get a mortgage when interest rates are low, and when interest rates are high, you're going to pay it off, right? Because they're high. So you still need an expectation with when you get a mortgage, what are you doing with that piece of real estate you're buying? So let's say you get a mortgage that looks really cheap, like say 3.5%. You buy this property, but let's say the property, it's not rentable, it's in bad condition. It's there's rent controls in place, there's lots of problems. So you got this cheap mortgage, but there's no way to cover the cost of that mortgage as investors. So what happens is you end up still paying all these payments, even though you got it cheap, right? So even though you got this cheap mortgage inside, what is your expectation? You need an expectation for the property that you're buying that it's tied to. On the other side of it, let's say interest rates, are really high, you got a variable rate, whatever, you pay off your loan. Well, you still have to have an expectation, right, that interest rates are going to go lower, or the money you're taking out of the bank can't earn interest higher somewhere else, right? So let's say interest rates, went off, you paid off your whatever, you got a loan, you paid it off, but the money in the bank, if interest rates keep going higher, would have made you even more. So you need an expectation on the other side. You can't just use the implied volatility. You need to figure out, what do I think is happening in the stock, and to realize volatility. All right, you need to still make those comparisons and analysis. All right, I think
all right, Dean, we're 2 minutes into the open. We did also have a question, maybe you can touch on tomorrow, from Area, that this graph is indicative only of payouts upon expiration. Is there a way to shift in the vol curve that the line will not be straight while there is some time left to expiration? I guess, is there a way to adjust the graph?
Yeah, you could adjust it. Yes, you could pick a date, right? But this is assuming, and you could see this will always, as long as the stock sits here, it's just going to decay. So even if I give this zero vol, let's say everything goes to zero vol here, zero vol. Basically, zero vol means it's parity, right? That's what, if I give it implied volatility, it won't matter which day you pick, because it's going to look like parity. What I'm saying is that if you did the spread, and implied volatilities went to zero the very next day, you're a big loser if you did this credit spread. Okay, that's the point I was just trying to make. So it doesn't matter which day you pick, right? Remember, zero implied volatility means all options are either worthless or are at parity, right? Same, so just like they are at expiration.
Nice job, my friend. Thanks for bringing it.
All right, guys. Thanks for joining. Stay safe out there. Have a great trading day, and I hope to see you guys tomorrow.
Trade in peace, community.